2024, the global economy recorded a modest recovery, with IMF reporting a growth of 3.2%. Kenya experienced a slowdown, recording a growth rate of 4.7%, weighed down by the effects of flooding and fiscal pressures. In response, the Central Bank of Kenya proactively implemented several measures to stimulate economic activity to spur growth to around 5% in 2025. Across our markets, we remained vigilant, adapting swiftly to changing conditions and maintaining strong risk oversight. Equity continued to strengthen its governance structures to match our growth and operational complexity across 6 countries. We closely monitored evolving regulations and aligned proactively, including compliance with Kenya's new capital markets regulations. To this end, we will table draft policies which are aimed at increasing our transparency and accountability to our stakeholders. Furthermore, the creation of our 4 business groups, namely the banking, insurance, technology, and foundation, requires us to be more vigilant in our board oversight role. Accordingly, we have strengthened our boards at both group and subsidiary levels. Dear shareholders, we will also table new proposed directors who demonstrate exceptional skills in risk and compliance, audit, strategy, governance, sustainability, and economics. At the subsidiary level, we have reinforced our boards with new expertise in technology, risk, sustainability, communication, legal, and health to support our subsidiaries' operations. We remain committed to cultivating strong and effective leadership to harness emerging opportunities, mitigate potential risks, and strategically position the group for sustained growth and long-term resilience. In line with our Africa Recovery and Resilience Plan, ARRP, the year 2024 saw us efficiently consolidate our footprint with the successful amalgamation of Koja Bank into Equity Bank Rwanda. We also advanced the operationalization of 2 major shareholder-approved initiatives, a banking holding company and a health insurance subsidiary, positioning the group for greater specialization and growth. On impact, our commitment to inclusive development remained unwavering. Through our education and leadership programs, we have awarded over 60,000 scholarships and onboarded 415 scholars into our innovation hub. In enterprise and financial inclusion, we have trained 2.47 million youth and women and disbursed 340.8 billion Kenya shillings to over 323,000 MSMEs under the Young Africa Works initiative. We have also supported 5.79 million beneficiaries with over 164 billion Kenya shillings in social protection transfers and planted 5 million trees, distributed nearly 467,000 clean energy products, and expanded the Equity Afya network to 132 outpatient centers serving 3.34 million patients.
Shareholders, I believe you have looked at our balance sheet in the audited accounts, and we see 2024-2023 financial years as if the balance sheet have stagnated, other than a slight increase in shareholders' funds of 13%, the bulk of it which is held in cash and cash equivalent. But if we normalize the year 2024 on constant currency, we see a growth of 18% of total assets, driven primarily by customer deposits, which grew by 23%, shareholders' funds by 29%, and that fueled the growth in our investments, but the bulk of the funds remaining in cash and cash equivalent, which grew by 78%. Shareholders, if we turn to our income statement, or profit and loss as would call it, we see interest income growing much slower than interest expense at 9% versus 19% for interest expense, leaving us with net interest income growing with only 4% and non-funded income at 8%, giving us a growth of 6% of total income. We see, as we indicated, our loans had picked up, and as a result, loan provisions are declining from 35 billion shillings in 2023 to 20.2 billion shillings provision. That leaves our total cost growing at 2% against the 6% growth in total income. And as a result, our profit before tax grew by 17% from 51.9 billion to 60.7 billion. Profit after tax grew by 12% from 43.7 billion to 48 billion. In terms of distribution of the profit available for the year, we see 16 billion shillings being devoted to dividend, with the retention, which is 34% of all available for distribution, and the balance being retained. And we see why the board is recommending a retention of 67% of the distributable or available for distribution. As a result, earnings having gone up by 12%, dividend has increased by 6% from 4 shillings to 4 shillings and 25 cents, giving us a dividend payout of 16 billion shillings, up from 15 billion shillings. Dividend payout ratio, as we said, is at 34.5, with a dividend yield of 8.9% and dividend yield on par value of 850%, which has gone up by 6%. So broadly, that shareholders represents the balance sheet and income statement for the year ended 24. But if we do a deep dive on these numbers, we see the regional banking subsidiaries contributing almost 50% of deposits, of loans, or assets at 48 or 49%, but revenue at 54%, meaning that the yield on assets is much higher in the subsidiaries. We see profit before tax, the subsidiaries contributing 54%, and our mother subsidiary, Kenya, contributing 51% of the profits.
As we look to develop value chains across our markets, there is no doubt certain factors of production is required for us to bring in to help develop these African value chains, which currently are fragmented. At the same time, access to markets will be quite a critical consideration for African value chains. One will appreciate that globally trade is reconfiguring, and you can see this taking place with the discussions around tariffs So as we look to develop value chains, as we appreciate the context in which value chains are reconfiguring, we believe representation in the UAE will help us connect Africa's value chains to global markets. Similar to what Singapore did as a trade and investment hub for Asia, we believe the UAE will do the same for Africa, and in particular East and Central Africa. So our opening of a rep office in the UAE is consistent with our strategic plan of developing value chains and connecting these value chains. You'll also appreciate that many multinationals and many of the partners that we are seeking to support the development of African value chains are headquartered in the UAE, particularly in Dubai, where we expect to set up our rep office.